Hi everyone, welcome back. This is part 16 of my Rivian deep dive. In the last video, we closed with discussing high-level free cash flow. In this episode, we discussed the drivers of free cash flow and a few other things. So down here again, you have the formula. Keep this always in mind. And now let's look at some typical key free cash flow drivers in any automaker. This is the change in inventory, and the change in inventory is driven by the relationship between vehicles delivered and vehicles produced. Here on this chart, you see in the purple boxes the vehicles produced, and in the green boxes the vehicles delivered. And here on the top, these changing size boxes illustrate the vehicle inventory. So in every quarter, when you produce more vehicles than the vehicles that you deliver, your inventory goes up. Rivian, just like Tesla, doesn't have a dealership model. This means when Rivian makes a model, but it doesn't deliver it, it sits on Rivian's balance sheet. This is very different from other automakers which have a wholesale model, which means they produce a vehicle, they ship it off from the factory, and at that moment they book the revenue. From their perspective, it's delivered, even though in many cases the vehicle ends up sitting for months on some dealer lot. It doesn't matter. The automaker will book the revenue. So when we look at Rivian, so let's take a quick look what actually happened before I look at the forecast in 2024. Rivian started the year with almost 12,000 vehicles in inventory. In the first quarter, they produced 14,000 vehicles, delivered 13,600. Sales kept kind of steady in the second quarter of 2023. Then there was a significant drop in 3Q 2024 for some other issues, and I'm going to dive into here. There was overproduction because they produced 13,200 vehicles. So that's why you can see that the inventory increased slightly after it decreased before. And when the inventory goes up, this consumes capital because you spend money, you spend cash on making the vehicle, but now you can't sell it, so you have to put it on the balance sheet. So the cash that you spend is recognized as a cash outflow and increases the negativity of cash flow. So this is what happened here in Rivian's case. Then, as we discussed earlier, fourth quarter you have to exclude because the number is completely irrelevant because of this huge one-off item of almost 2 billion deferred revenue. But the big picture point is that Rivian had a cash burn of almost 2.9 billion in 2024, all things added together. But again, this includes almost 2 billion of deferred one-time revenue. This is not recurring. This is the VW JV revenue expected for the next 3 to 4 years. So there's a one-time cash infusion. So if you adjust for that, the 2.8 billion down here, or 2.9 billion rounding correctly, is 4.9 billion on cash burn. So this is so Rivian burned nearly $5 billion in 2024. Again, the operating business brought in 5 billion too little to pay for everything in terms of cash. So now, with that in mind, 2025 makes a lot more sense. You can see, oh, cash burn is 4.3 billion. Because without that knowledge, you might think, oh, they only burned 2.9 billion and HA forecast, you're crazy, 4.3 billion. No, the adjusted number is almost 5 billion. And that's why you actually see a significant reduction in cash burn is reflected here in this forecast. So, and then let's look at this at 2025 a little bit more closely. So Rivian told us they expect deliveries of only 8,000 vehicles in the first quarter. This is actually a long-term low. Rivian justified this with seasonal factors, and yes, it's true, there are seasonal factors in the auto industry. They also justified this with high concentration in the California market, and they also even mentioned wildfires affecting their demand. Okay, let's assume that's correct. But Rivian also told us they expect like 14,000 vehicle production, and they overproduce so many. And this is why you see the inventory going up a lot in order to prepare for the long-announced factory shutdown in the second half of 2025. So what they're doing is they're overproducing in the prior quarters before the factory shutdown to have enough inventory to last them through low production periods. So, and this is why you have this increase in inventory and then it goes down again. My assumption is that the factory shutdown takes place end of 3Q going into 4Q and will be wrapped up over a 4-week period. So that's why you have not like a complete decrease in production. So it reflects basically 3Q takes some blow to production, and then also 4Q, but 4Q assumes a quick ramp up after the production shutdown. And then in 2026, you also see some increase in inventories. This is in relation to the R2 platform launch, because often when you rent a production, you have simply the vehicles can't be delivered on time. So that's why the underlying model assumes some mismatch of production and deliveries, which then also drives the vehicle inventory. Further, in just prior to the R2 launch, Rivian might also build a little bit more R1 product. So once the R2 launches, they can focus or reallocate resources to help out on the R2 lines if need be. This would be a prudent move, and I've seen this from other automakers. And then later into 2027, you see how global inventory increases peak levels, but still, relatively speaking, is relatively low, because then of course the R2 has already scaled into meaningful material volume, and there's just a lot of product in transit, unfinished goods is not included here, but there's just a lot of vehicles, completed vehicles in transit, and also Rivian talked about increasing their selling footprint, etc. So there will be showroom vehicles, etc. plus and vehicles waiting for delivery. So there's just naturally an increase of the vehicle inventory, and this also consumes capital. So this capital consumption, this increase in vehicle inventory is capital consumption on top of net losses, and it represents a main driver of operating cash flow. That's the first key metric for the free cash flow calculation. But then the other one is the capital expenditures. And this will be the last piece we'll be discussing in this video series. So the CapEx projection in this forecast leans heavily on management guidance. So for 2025, Rivian told us they expect 1.6 to 1.7 billion in CapEx. The forecast here again assumes optimistically Rivian spends at the low end of their guided range. So the forecast assumes 1.6 billion. This is a 40% increase year on year, but again, this is management guidance. On top, just a few days ago, management told us we expect to have a year-over-year increase in CapEx 2026. So they already know they're going to spend more, and these things tend to be quite accurate because they have quite specific product launch schedules. They have very detailed plans on everything. They literally know what week, what machine will be installed in a factory that is yet to be, or a building that's probably not even in existence right now. But long story short, this is typically quite accurate. But they didn't tell us the exact number, and I assumed a 20% year-on-year increase. But again, 2026 is significantly driven by the R2, so this is the key driver for that. And 20% looks like a lot, but it looks quite high because, again, we are using the low end of the guided range. So if they come in at like midpoint, this 20% immediately goes down to 16%, even though the number doesn't change. It's still 1.9 billion. Hence, this CapEx projection is still probably not very aggressive. And then 2027 is basically driven by the same assumption, another 20%, as Rivian tries to scale to significantly larger production volumes. Of course, this assumes that there is a significant take-up for the model, and this is consistent with this entire forecast, because this forecast assumes Rivian can achieve a very high gross profit margin, which also implicitly means that there's good demand, otherwise you cannot sell vehicles for this price. Or for a price that would generate such a high gross profit margin. Again, this shows you another degree of sort of optimism built into this forecast, but capacity expansion consumes capital and is cash flow negative. So this brings us to the end of part 16. I decided I make one more part, and we'll just go high level to the key points for investors. So this was part 16, so see you in the final one. Thank you for listening. Bye.